So welcome to the next episode of Skill Building. Today we are talking about liquidity. I'm doing my little timer again, so we have 10 minutes to explain liquidity, why it's important, why does it move the market, and what are important draws and how we can use it for us to profit from it. So 10 minutes, log in, and we're gonna start right into it. So, what is liquidity? Yeah, everyone on YouTube tells you liquidity is important, here liquidity, there liquidity, on every market, but what is it actually? There's three types of orders in markets. There's market orders, limit orders, and stop losses. Market orders are directly filled. They are active and directly inside the market. Then there is stop losses and limit orders. Stop losses are orders which are triggered when a specific price is hit and people want to exit the market. And there's limit orders, which are orders which are placed on a specific price where people want to enter the market. So these orders are active, but they are not filled yet. They are not in the market right now. So these orders move the market. So why do the orders move the market? And why it's important for us? There's one big rule in trading, and overall in in all this trade, it doesn't matter what you trade and everything. The big people, they never lose, and the small people lose every time. So, for example, if we have an uptrend right here, there's people betting that the uptrend is going to continue. So, those people who continue the uptrend, they want to long somewhere around here because we have higher lows and they expect another higher low. So, we get maybe a little response and they long here with a stop loss down here. So what is likely going to happen? We're going to take out those stop losses and then go up. Yes, they have the right idea about what the market's going to do, but the big people don't let small people win. They don't accept people who are long here and win and get all the percentage of those moves. It's never going to happen. In the other way around, there's also people who expect the market here to go way lower. So they short right here. And if we actually want to go lower, they place a stop loss right here. And what is going to happen? We're going to go out, get the stop losses, and then the move happens. Because the big ones, the people who manipulate the market, they never want you to win. They always try to keep the majority of people out of their positions and then start the move. We go into a pretty good example right here. You can see right here, we have a downtrend. Yeah, we have a high, a lower low, a lower high, a lower low, a lower high, lower low, and so on. And now we get a break of structure. Okay, so people now expect I long here because I think we get a reaction and we go up. Okay, well, they put their stop loss here because this would be the invalidation point. And now you can see what happens. We go down, we see all the stop losses, and then we actually go up. Now there's this question why we don't go up like in a faster, explosive manner and we chop here. You will understand this when we discuss order blocks and breaker blocks and in the last video about SMC in general. But we're gonna take out the most orders and then the move happens. So let's see on the chart in general. But we can spot this everywhere. Here we have chopping around and the move is gonna be down. So people shorting here. Before the move happens, we take out all the people who set their stop loss above those consolidations. Again here, we have, let's see where's a good example. Again here, we have the market turning to the upside, but we first sweep out the stop losses here. And we push people into shorts right here to make them lose money. That's the only idea the big people have. How can I make people lose money? That's it. And that's why liquidity sweeps happen. For example, also here, there's a big move up happening. People are shorting. Now we get the first reaction to the downside, and people short and put their stop loss above this high. What happens? We get out all the stop losses, and then we go down. Where do we go? Where do we go before we go higher? The last recent low is right here, where people have their stop loss who are longing all of this. What happens? We go down, we sweep out those lows to get all the stop losses and then go higher, to not make them profit from this huge move. So every time there's a huge move, there will be some sort of stop loss taking before the move happens, because people, they want you to lose money. They don't want you to get a move and profit from a big move. So that's why liquidity sweeps are happening, and with those liquidity sweeps, the big people can actually enter the market, because without liquidity grabs, they couldn't enter into the market, and they always win, they always make money. So you may not understand right now why they cannot enter without liquidity sweeps, but in the last video about SMC, you will understand this. So this is the most important about liquidity sweeps. Before a move happens, we always try to seek out stop losses. And now you know how the market moves and why it moves, why it's important. You know what liquidity is. Spot liquidity, we also did this, how you can spot the liquidity sweeps. And we have important draws. Before we focus on important draws, let me tell you one more thing, which is important. Liquidity sweeps happen everywhere, every time, and on every time frame. So you can spot liquidity sweeps not only on indexes, but on crypto, on every stock, on gold, on silver, on everything. And they happen on every time frame. Yeah, we can go on the weekly time frame and see that there's liquidity sweeps. Best example here and here. We go down, we sweep out the two really obvious lows where people have stop losses to long this. And we go down, we get all of this, and bye-bye, we go up again. But also on the 1 minute time frame, we can see that this is happening. Let's go to the 1 minute time frame, and we can see where this happens. Best example, right here. We have an uptrend, then we go down. And people think, okay, I'm gonna short now. Maybe around here. They see, okay, we're going down, I'm shorting. They short somewhere here, put their stop loss above the high, the last high, because the downtrend has again lower highs. And they put their take profit somewhere around here. What happens? We seek out the stop losses from here, from this high, and then we actually go lower. On every time frame this is happening, because on every time frame there is starting of moves, and the big people don't want you to win. So that's why liquidity sweeps happen. Here, same thing. Low, we have a downtrend, we get a break, so now we're expecting the uptrend. What happens before? We seek out all the stop losses from people who longed here, and then we go up. Same example right here. We have a downtrend, we have a reaction to the upside. People are longing here and put their stop loss above here. What's happening? We take them out and we go higher. It's the same every time, and that's why liquidity is so important, because liquidity is not only a confluence. Liquidity is a deep understanding of the market, and you will get this deep understanding of the market if you watch the other videos about the other confluences and the last video about SMC, where we explain the deep why of everything and why it's happening. So let's focus now on the last step and tell you what are important draws of liquidity. Which types of liquidity are there, and which liquidities are most likely to get taken out. Because for example here, there is a low and there is a move up, but we don't actually grab this low again and then go up. All the people who went long here, they are in profit and they made profit. So what are important draws of liquidity which are always going to be taken out and which hold the highest power? So if we have a high time frame liquidity draw, this holds higher power. So a liquidity spot on the weekly, for example, here or here, is way more important than a liquidity draw on the 1 minute time frame. Higher time frame, higher power. So liquidity is resting over highs and over lows. We already know what this is. So highs which are built and lows which are built on a higher time frame have higher liquidity on there. Why is that? Because more people are trading on bigger time frames. There's a lot less people who are trading on the 1 minute and a 5 minute time frame. People who are not so deep into this space, they will never open the 1 minute time frame. They will look to the 4 hour, to the daily, to the weekly time frame. And they put their stop loss and limit orders there. So that's why they hold higher power. So high time frame, big draw of liquidity. Then session highs and lows. Yeah, if you remember from the first video about general, I explained to you that there are sessions, and inside of those sessions there is a lot of liquidity, a lot of money flowing into the market, and therefore, for example, when a new session like London session starts, the first interest of them is to seek out all the money from the Asian traders, because there will be some really obvious high or low inside of Asia session where all the Asia traders are in. And when London session starts, there's new money coming to the market, and the big people, they want to get the move for the day, for their session to make money. And they can only enter if we seek out big liquidity. And big liquidity, for example, is over Asia highs or over Asia, below Asia lows. Why they can only enter there, you will get explained in the last video. But for now, you have to just accept. So this is the second, sessions and high time frame. And there's one more, there's low resistance liquidity. This is liquidity on a lower time frame, but stacked up, really stacked up together together to make it an easy draw. So for example, if we check this, there is liquidity here, there is liquidity here, there is liquidity here, there is liquidity right here. We have an imbalance. You don't really know yet what this is, but we have an imbalance right here. There's so much liquidity to grab here, which is really attractive for market makers. Same like if you check this one here for the other direction, we are right here. And now we have liquidity here, we have liquidity here, we have liquidity here, we have liquidity here, we have liquidity here. That's paradise for the market makers, because when they go up here, they can eliminate so many people. They can make so much people lose money, and they can enter again. And that's it for liquidity. So you know what liquidity is resting orders. You know where to find liquidity, how to spot liquidity, why liquidity is moving the market, and how we can profit from it. Because if we see a liquidity sweep, we know that there might be a market structure shift. And after a liquidity sweep, we know that banks and institutions entered already. So now the real move can happen. The real move doesn't happen without institutes and banks. So now with the liquidity sweep, we know they are able to enter now. Why? We discuss later. So we can trade together with them and not get stopped out again. So that should be it for liquidity. Fast overview, and we're gonna see in the next episode.